Hello, and welcome to the webinar on challenges and solutions to buying or renting a house in 2025. My name is Linda Williams, and I am a community outreach and training manager at Consumer Action, as well as your host today. We have an excellent webinar for you featuring three dynamic speakers. However, before we begin, I would like to thank our sponsor, Wells Fargo. Consumer Action presents this webinar with funding from Wells Fargo. Wells has been a great partner, and on behalf of the entire staff at Consumer Action, I would like to thank Wells for their support and belief in our mission. Now, before we dive into the essence of today's presentations, I would like to cover a few housekeeping items to ensure a streamlined and efficient experience for everyone, respecting your valuable time. This is a 90-minute webinar that is being recorded. You will receive a link to the recording within a week, along with accompanying handouts. You will also receive a link to a couple of videos that you can watch at your leisure. I've had the pleasure of watching the videos. They are very good. So when you have a moment, click and enjoy. We encourage interactions and we love to hear from you. At the end of all presentations, my colleague Nelson Santiago, he's going to lead a question and answer segment with our guest speakers. This is your opportunity to engage, so please put your questions in a designated box and click submit. Also, before you sign off today, kindly take a moment and complete the brief survey evaluating today's training. We truly appreciate your input, and we would like to know if we met your expectations. Now, for those of us who are new to Consumer Action, let me introduce you to our organization. We are a national nonprofit dedicated to education and advocacy. What sets us apart is our commitment to all consumers, especially underrepresented consumers nationwide. See, we empower consumers by providing multilingual educational materials, engaging in community outreach, and focusing on important advocacy issues. We assist low and moderate income individuals, limited English speakers, and other underserved communities across the nation in achieving their financial prosperity. For over 54 years, Consumer Action has been a reliable partner for consumers on their financial journey. Our long-standing commitment and extensive experience build confidence in the communities that we serve, ensuring that they can trust our support. Okay, so let's get ready to dive into today's presentation. I am honored and pleased to introduce the knowledgeable and passionate individuals who will be sharing their insight with us today. Our first speaker is Sharia Nabi. He is a senior research associate at Aspen Financial Security Program, where he researches where he researched data to uncover insight about the most pressing challenges to financial security in the United States. His work spans a range of topics of critical importance to household finances, including emergency savings, retirement security, affordable housing, and climate hazards, just to name a few. Before joining Aspen, Sharia was a content specialist at Prosperity Now, where he promoted research and advocacy efforts to build assets among low and middle income communities. Joining Sharia is Gabe Derrio. Gabe is the president and CEO of Home Ownership Council of America, where he works on solutions to credit access for underserved communities in home ownership. He serves this work by providing thought leadership, technical assistance, and services to banks, IMBs, credit unions, and investors in affordable and special purpose credit program lending. Gabe is a certified mortgage banker with extensive experience building products, delivery systems, and technology focusing on increasing access to credit for underserved markets. Joining Gabe and Shariar is Sharon Cornelison. She is the Director of Housing for the Consumer Federation of America, where she advocates on behalf of American consumers for affordable home ownership and equitable mortgage lending. She brings a decade of experience as a housing researcher and advocate. Prior to CEPA, she worked as a postdoctoral fellow at the Harvard Joint Center for Housing Studies. Doing her PhD in sociology from Princeton University, Sharon lived in Detroit and firsthand observed the challenges of home ownership amid neighborhood decline. She also gained expertise as a tax foreclosure prevention activist in Detroit and intern at Detroit Land Bank Authority. She has a book forthcoming in November titled The Last House on the Block: Black Home Ownership, White Homesteaders, and Failed Gentrification in Detroit. I want to welcome all of our guest speakers, and I want to turn the presentation over to Shariar. Let me give you control so that you will be able to advance your slides. Shariar, you should have control. Yes, you should have control. Just take your cursor in the circle and push down.
Okay. Got
There
it.
we go.
All right. Thank you, Linda. And hi, everyone. And thanks so much to Consumer Action for hosting this session. I'm Sherry Arnabi. I'm with the Aspen Institute Financial Security Program, where we work to lift up insights about the financial challenges facing American households and convene leaders to make financial security a national priority. So part of making sense of the conversation around challenges to renting or buying is to understand the financial picture of renters and their journeys to building wealth, whether they become homeowners or not. The pandemic was an eventful time for renters, leading to both important shifts in renter wealth, but also challenges that persist to this day. And the lessons from the pandemic show us that prioritizing the right kinds of support can lead to meaningful improvements in renters' finances. So our program has published some research looking into this topic, and today I'll be sharing some key insights that can inform all our efforts to support the financial security of renters. So first, why talk separately about renters? To start, I want to emphasize the importance of personal wealth to have financial security and being able to do well and thrive. Wealth allows people to save, protect themselves against financial shocks, pay off debt, and invest in the opportunities to benefit both themselves and their families. But renters face the biggest barriers to wealth building in our country. As of 2022, 90% of all renters were in the bottom half of the US wealth distribution, and median renter wealth is just 3% median homeowner wealth. Renters also take up a significant share of the population. They're a third of all households, and we're going to see more renters in the coming decades as the growth in renter households is projected to double homeowner growth by 2040. So this tells us that renters have a particularly large need for opportunities to grow their wealth. And this is becoming only more important as more and more people in America are expected to be renters in the future. So one of the biggest barriers for renters' wealth building is the fact that they don't have home equity, which is the largest source of wealth for most households. At the same time, renters have been burdened by higher rents, making it harder to protect against a financial shock and save. Housing unaffordability accelerated since the onset of the COVID-19 pandemic, and the numbers here are really record-breaking. So rents remain elevated, with a 22% increase in median rent for a two-bedroom apartment from 2019 to 2024, although that rise has slowed down a bit since. Home prices are near record highs. The current median home sales price is above $400,000, which is $100,000 higher since 2019. Renters are taking longer to save for a home, as the typical first-time home buyer was 38 by 2024, which is the highest on record. And the share of first-time home buyers is a record low. Just about a quarter of the home buying market in 2024 was first-time buyers, which is down almost 10 percentage points since 2019. As homeownership grows more unaffordable, we need to ensure that renters have opportunities to grow wealth at all stages of life, regardless of whether they will own a home or not. So motivated by this idea, my colleague Stephen Brown and I investigated renters' financial well-being in our report From Rent to Riches, a profile on the wealth and financial well-being of renter households. The insights in the report are based on both existing research and our own look into survey data from the Federal Reserve that provides a detailed look at American family finances. And today we're going to overview what we learned. So first, looking at just the current picture of who renters are today by looking at some key demographics, trends and lessons from the pandemic for renter finances. And finally, we'll talk about what we've learned about renter financial well-being and how that can inform solutions to grow their wealth. And after the webinar, we'll be sharing a link to the full report and a short video explainer of its findings for you to explore further. So to start off with, to give us a baseline general picture of who renters are, let's take a look at some of the key demographic facts comparing renters and other kinds of households. So if you look at the top of this table here, where it says age, you'll see that renters tend to be younger than homeowners with a median age of 42 compared to 57. But we may have a picture in our mind of renters being even younger. So 42 might be older than we assume. Then looking at the bottom of this table towards the race and ethnicity section, you'll see that more than half of renters are people of color, compared to 28% of homeowners. I also want to call out here that renters are slightly more likely than homeowners to be female and have a disability. So when we think about renters' financial picture and solutions, it's important to keep in mind that we're talking about a relatively younger, more diverse population that may also face greater barriers to wealth building than the homeowner population. Looking at income, we can see in this table that renters tend to earn substantially less than other US households, with a median income of nearly $52,000 as of 2023, about $16,000 below the national median. But this table also tells us that renters have a diverse income profile. Nearly half of renters have incomes under $50,000, but over a fifth earn more than $100,000. Renter income also grew from 2013 to 2023, and we can see here that the fastest growth was among renters earning $100,000 or more. So while renters tend to have less income, they represent a wide range of income bands, and most saw their earnings grow in recent years, but are still finding it difficult to access homeownership in the current market. So with this baseline picture of renters, we now turn to what renters experienced during the pandemic. The COVID years, as I said earlier, were an eventful time. So first, what we point out here is that there were historic gains in renters' wealth, though they still remained far behind homeowners. These gains were associated with pandemic-era support for income and expenses, suggesting that these kinds of supports can make a difference. However, the gains faded as supports expired and renters were hit with cost of living increases and rent inflation. So in the following slides, we'll examine these themes more closely. So first, during the pandemic, renter wealth reached its highest point on record. So in the middle of this bar chart here, from 2019 to 2022, renter wealth grew from a median $7,300 to $10,400. That was a 43% increase, which was faster than the growth homeowners experienced in their wealth. And this is also the highest level of wealth we've seen in the 30 years this figure has been reported for renters. But this chart also shows that renters' wealth remains far behind that of homeowners. Homeowner wealth grew to nearly $400,000 at the median during the pandemic. And as we noted earlier, renters' wealth is just about 3% that of homeowners, despite the gains they made. So while there was overall progress during the pandemic, renters still face significant challenges, and there's still a lot of work to be done to improve their financial picture. So what explains the growth in wealth for most renters? When we break down the components of wealth, which is assets and debt, we can see that during the pandemic, more renters had space in their finances to invest in assets and pay down debt. Looking at this chart, and just to note, the numbers here represent thousands of dollars. We can see from the dotted green line that after 2019, median asset values, and that means the value of things like bank accounts, retirement accounts, cars, and other kinds of assets. The median asset value for renters grew the fastest it had since the Great Recession. The other dotted line here shows that median debt levels for renters have also seen a steady decline since 2016. So these shifts were associated with government supports renters received for both their income and expenses to weather the fallout of the pandemic. They got income boosts from interventions like economic impact payments and the advanced child tax credit, and eviction moratoriums, emergency rental assistance, and student loan forbearance provided relief for ongoing payments. I want to note in particular that student loan payment pauses were particularly beneficial for renters, since more of them have student loan debt than homeowners. So all of this indicates that supports opened up the financial space for renters to invest in assets and reduce their debt, ultimately building their wealth. So when we look at the kinds of asset gains that renters made over the pandemic, it shows us an opportunity to grow their wealth both outside of having home equity, which in today's market is becoming harder to reach, but also towards becoming a homeowner. And this is because during the pandemic, renters increased their investment in assets that have the potential to appreciate in value and boost their wealth over time. So outside of home equity, that includes things like retirement accounts, stocks, potentially business equity, real estate, and other financial assets. And holding these assets and seeing their value grow in the long run is a significant driver of wealth building in this country. That's really a huge reason why home equity is a really important part of most Americans' balance sheets, because of how much they can appreciate over time. So during the pandemic, we saw more renters acquiring assets outside of home equity with appreciation potential, indicating that supports for income and expenses can lay the foundations of long-term wealth building. So let's look into these gains in appreciating assets. We found that from 2019 to 2022, renters holding these kinds of appreciating assets grew from 45% to 48%. And looking at the asset breakdown in this table, we can see that that growth happened as more renters opened retirement accounts, purchased stocks, and started businesses. I want to note that car purchases increased as well, but that's not included in our figure for appreciating assets since cars lose value over time. But notice the big gap here between homeowners and renters. We found that 78% of homeowners own at least one of these potentially appreciating assets, far more than renters. So what all of this indicates is that when more renters had that financial space with the help of supports, they invested in wealth generating assets that could build on their wealth gains through the power of appreciation, and sustained supports have the potential to unlock further gains in wealth building. However, more recent evidence suggests that these gains aren't being sustained. Pandemic era supports ultimately expired while rents grew and inflation increased the cost of living, leading renters to spend down their savings from stimulus payments and rent and student loan pauses. This chart here shows that while renters' self-reported financial well-being improved as they built wealth during the pandemic, by 2023, it had dropped to below what it was in 2019, with just 54% of renters saying they were doing at least okay financially. Also notice how large the gap in financial well-being is between homeowners and renters, with homeowners consistently reporting much higher levels of well-being. And in the aftermath of the peak pandemic years, we are left with the persistent challenge that most renters struggle to achieve financial stability. They still need that space in their finances in order to grow their wealth. Of particular concern is renters' ability to secure positive cash flow. Having positive cash flow means that your income exceeds your expenses, allowing you to build a savings buffer to protect against financial shocks and build towards larger purchases. As this chart shows, most renters don't have positive cash flow and have been consistently less likely to have it than homeowners. While renters saw some improvement at the height of the pandemic, as of 2023, rates of positive cash flow had dropped below the pre-pandemic level, with just 40% of renters bringing more income in than their expenses. I also want to call out another critical issue for renters' financial stability, the issue of debt, which plays a key role in wealth. But renters have also faced challenges here. As of 2022, 18% of renters had a late debt payment in the past year, almost double the rate of homeowners. Renters are also less likely to have strong credit, which hurts their ability to borrow for wealth-building purchases such as a home. Research from the Urban Institute found that over half of renters have credit scores above 750, over half of homeowners have credit scores above 750, compared to just 19% of renters. So these signs of struggling with cash flow and debt tell us that there's a need among renters to create financial stability and ultimately the space in their finances and that slack in their finances and cash on hand to protect from emergencies, build savings, and open up opportunities to invest. So what can we do to create that financial space and accelerate wealth building for renters? So based on what we've learned about renters' financial challenges and the potential when supports are working in their favor, we offer 3 priorities as a framework for action. So, and this is very much a both and approach, kind of all hands on deck, all possible solutions very much should be on the table here. So first, renters need to be able to address rent burdens and cash flow so they have that core financial stability that creates space in their budget. And for all these solutions, there are a lot of ways to do this. I'm just going to call out a few examples to show what they look like in action. So example are ways to boost wages and income, rental assistance, expanding affordable rental housing supply, and supportive public benefits. And the second priority here is to increase renters' access to a broad portfolio of assets. So as we saw during the pandemic, one of the drivers of meaningful wealth gains was the ability to acquire a range of assets spanning retirement accounts, stocks, and even starting a small business. So it's really important that if homeownership is unaffordable, renters have those options for building wealth through other pathways. And so some examples here are programs that that enable cash savings, an example being Family Self-Sufficiency Program at HUD, strengthening access to retirement savings and market-based investing, early wealth building accounts that start savings from youth, and then also innovative asset classes such as shared real estate. And finally, Although there are challenges to affordability for homeownership, it still remains a critical way that people build wealth in this country, and people should still have opportunities and pathways to becoming a homeowner if they wish to be. And so some of the ways to get there are expanding access to down payment assistance, credit scoring and underwriting enhancements, building more starter homes, and then issues related to preventing generational land loss by allowing people to continue to own and maintain passed down homes. And I'm going to conclude this presentation just by acknowledging changes in the federal policy environment and what that could mean for solutions for renters. So on the one hand, there could be new major challenges up ahead that makes it harder to achieve these wealth building pathways. Proposed cuts to HUD rental assistance programs and recent cuts to SNAP and Medicaid, these could increase cost burdens that make it harder to have financial stability that renters need and really constrain that financial space that's so important to be able to invest. And any more burdens on top of that just makes it really, really hard to pursue those pathways. At the same time, we might see opportunities in actions such as an expansion of the low-income housing tax credit that could bring more affordable rental housing on the market and put some downward pressure on cost burdens for renters. But in this changing policy environment, it's going to be important to fill gaps in renter support and also innovate so that renters have more options and opportunities to improve their financial picture. And the priorities of addressing cost burdens, expanding access to more types of assets, and smoothing the pathway to homeownership, they can serve as organizing principles so that we can still do the most good for renters despite these changing circumstances. Thank you.
Thank you. That was an awesome presentation. Now let me take control from you and turn it over to Gabe. Gabe, you should have control. Let me double check. Wait, no, you don't. Now you should have control, Gabe.
Okay.
There you go.
Great. Hi, everyone. Happy to be here with you today. Thanks, Linda, for having me. I'm going to tell you a little bit about our organization and how we approach the mission, and that kind of brings up topics to discuss, and hopefully you'll have some questions and discussion at the end. If you don't know our organization, which I wouldn't be surprised, but we're sort of a behind-the-scenes group, and we work with lenders and organizations all across the country. We're Homeownership Council of America. This is our mission statement: building equitable access to credit for America's underserved communities. So we do that by and large through our partners, and really it's our focus is about building products, programs, partnerships, delivery systems that actually create the opportunities for folks and deliver that to the ground level, to the home buyer. So we're a national group, a 501c3. We provide technical assistance by and large. I'm going to tell you a little bit about that. And then we also have a national DPA platform. We're represented with a national board and our National Equity Advisory Council that advise the organization and provide oversight for our programs. We try to be different in this space, and we bring unique experience. We're very focused in the lending sector, and our team are all subject matter experts in mortgage lending, housing programs, HUD services, HUD housing counseling, CDFI management. And I myself am a certified mortgage banker. I always say I just represent our pack of geeks as a head geek. We like to be effective and impactful. We really do. We've been doing this work for a long time, so we've chosen our angle, and we want to see that what we're doing has real impact. So we're proud to say that when we look back with our partners, we see transformation. We see new products throughout markets all around the country. We see learning and concrete processes installed. So that's that we're joyous to do this work, and we like to say we facilitate our partners' growth and success. There's more information about us on our website. Our Climb program is our core social enterprise. I do recommend this to any nonprofit out there to try and create a social enterprise. This has made us less grant dependent because we earn our fees, frankly, through working with folks. And this is our Community Lending Initiatives in Mortgage Banking, or Climb program. And what we do is we work with CDFIs, mortgage bank lenders, which would be IMBs, banks, large banks, small banks, credit unions, nonprofits and for-profits. I would say a lot of for-profits, though, because they do provide a lot of scaled production in this space. And what we do with them is we build affordable products, we build special purpose credit programs, things that programs that will meet the needs of underserved communities and increase the production of that partner, that lender, in that space. And that is how we focus on reducing the gaps. And so, and the more folks and the more lenders out there that we can work with, the more folks will constantly be out there with the right tools and methodologies to close those gaps. So that's always been our core mission and program. Here's some examples of Climb engagements. We've helped CDFIs become mortgage brokers or originators, all the way up to being a seller servicer to the GSEs. There are very few examples of that in the country, but plenty of times when a housing counseling organization or a housing organization that has down payment assistance could in fact be originating first mortgages and earning a significant revenue along with that business line. So that would be an example of a social enterprise where you're still serving the same customer, you're still achieving that mission, but you're adding a income or revenue generating line. And so we've done a lot of work like that with partners. We've also helped investors, so folks that are buying loans or providing the capital for groups out there to create or build a delivery system for that capital that will reliably serve low income or minority lending goals. We've done a lot of plan writing and product writing for mortgage companies. We've worked on small dollar loan production, which is a difficult nut to crack, especially on the two coasts. It's a little bit more productive in the middle of the country. But you can imagine in high cost markets, nobody wants to do the small loans. And so opportunities that are affordable are often passed by the standard lending world. So that's also an opportunity for nonprofits and CDFIs to get in that space. We've done many down payment assistance programs, worked on helping folks to affect their CRA program, and then special purpose credit program design I'm going to tell you a little bit more about, I think, when I get to the issues and how we work on them. So I tried to make a summary here for Linda, because she just sort of asked us to go over how, what are the big issues that we all are aware of, and what's HCA doing about it? And so now we can sort of talk through that. So the issues that we can all agree on are on the left there, and then our focus area. So the home ownership gaps. Well, there's actually quite a few different types of gaps. I like to say gaps because there's an affordability gap, there's access gaps, there are gaps in racial and ethnic gaps, there are gaps in sexes, there are all kinds of gaps that you can look at that in different ways. But the biggest, most obvious gap is the racial homeownership gap. And so we've done some writing and studying about that. And then we've done a great deal of work to advance special purpose credit programs. So I'll just take a minute to explain that. If you haven't heard of these programs, this is something that was always a part of ECOA Reg B. Since 1978. And what it says is basically the Equal Credit Opportunity Act, sorry, ECOA, if you're providing equal credit to everyone, then you should have parity among everyone that you're serving, right? But if the data shows that you have disparities among the folks that you're serving, among that population, even though you have treated them all equally, then in fact you can create a special purpose product or program that is meant to pierce the protected classes that are assigned within ECOA. And so things like race, ethnicity, sex, for instance, religion, the protected classes that actually religion is not there. I should have misquoted that. But sex and race certainly would be protected classes covered by ECOA. You can pierce those classes. And so when we look at the racial homeownership gap and persistent under access to capital and under access to home ownership or under service there, special purpose credit is a really fantastic tool to address that disparity. And so that allows a lender to create, for instance, a down payment assistance program or a credit or an enhancement to a product that's only available in certain areas or to certain populations. And that's being targeted based on the data so that you can turn that disparity into a level playing field, level parity. And that would be the goal of these programs. So our partners out there in the policy space advocated to make sure there was clarity from the federal government on that. And we came in to create a toolkit. When we got that clarity, we built that toolkit for MBA and NAFA, our partners out there, and it was used along with our TA by hundreds of lenders around the country over the past few years. And those lenders put out special purpose credit programs. And so even though we're in a time when politically this has essentially ended, because this with DE&I, with the executive order, the discussions around this have ended. The GSE's support has ended, so that Fannie and Freddie no longer have SPCP programs or SPCP pilots. Lenders do have them, but they're quietly issuing them around. But it's kind of a sad way to arrive at quite an accomplishment, which is that this field of lenders out there really served a great deal of people. We're still counting. And so I gave you a very low quote. We're working on a paper right now with Urban Institute and Living Cities to help document SPCPs and make sure that those lessons learned and all the methodologies are documented for history. But at least a couple 100,000 new home buyers of color happened in the past few years. I think it's more like 3 times that number, but we'll see when we're done tallying everything up. We're slicing and dicing the Home Mortgage Disclosure Act data with some data partners to see how we can extrapolate that number. Unfortunately, we can't just look up which ones were SPCPs, so we have to have a methodology that's defensible. But hundreds of thousands of new homeowners were made, and the gaps actually narrowed. And a lot of that had to do with lenders out there focusing on this and utilizing the tool of special purpose credit programs. So we're part of that chorus that sang that tune, and we provided TA to a ton of folks out there doing that, and that has made quite an impact. In affordability and in special purpose, we've provided technical assistance to over 65 lenders directly, and then hundreds more have used the toolkits information. And we, just among our direct partners, we have active affordable lending products in all 50 states. So we're really proud to be small but mighty there and work through our partners to get that kind of reach. We've solved for and now host down payment assistance solutions nationally. This is another problem we saw in the affordability and special purpose space, where there are so many programs around the country. They are underutilized and often hyper-local. So when you look at down payment assistance, it's usually managed by a city or a town or a county. And the mortgage industry just does not operate based on that kind of geographic restriction. They are used to having state level programs and products. And so when you add up all the different down payment assistance programs out there, it becomes an insurmountable task for many lenders to engage with. And while there are systems out there to help with that, it is still shied away from, and it's still operationally a big challenge to have that many counterparties within your system to work with as a lender. And so we set about on a different path. We tried to solve for how could we provide that anywhere and nationally, so that when we can raise money for down payment assistance, it can go out anywhere. And so we solved that methodology here at DPA. Here at HCA. We piloted it for a couple years, and it's expanding now. And that's our national DPA solutions. That's one way that we work on affordability, and it's also a special purpose credit program for households of color that are not low income, because that's really an important category to serve. In the housing supply section, which, this is not an exhaustive list, by the way, but our Climb program does work on housing supply, which is a critical issue. Sherry R. mentioned it earlier, that we must, find entry-level supply, and we are down units or net negative units in almost every state by tens of thousands, and sometimes hundreds of thousands for the larger states. So we're way behind on supply, but we're not a builder, so we don't do that. But what we do with our Climb program is we work with CDFIs and builders to help raise capital, to provide formalized programs and products that help people deliver those programs or help to deliver more construction. So we've done, for instance, ADU financing for CDFIs. We've done affordable for major home builders, where they're creating a program that has a pathway for affordability, or has a carve out for underserved communities, and therefore serves them in greater volume. And in the policy sector, we don't have an active policy arm at HCA. So what we do differently is we actively participate in a lot of councils and committees, and we provide technical information, because oftentimes policymakers haven't had or don't do the on-the-ground implementation of that policy. And so there's a need for technical explanations and examples to show how that policy will actually roll out on the ground. And that's really important and useful in the policy-making process, because you can make smarter policy, and you can make it be more effective. And so that's how we affect that space. Here are some video links. You're going to get this. We're not going to get to watch these videos, but I'm just going to highlight them really briefly. You're going to get sent out, and I love these videos. First of all, they tell a first generation story, and right now, I would say in an environment where people are feeling less able to be safe talking about racial equity or racial homeownership gaps, that a way to attack that problem and still serve everyone, which is a goal of other folks that are interested there, is first generation as attacked. And so first generation home buyers are predominantly found in communities of color, but are not exclusive to communities of color. And so, in any event, these two videos tell some really great first generation stories. Jose is a low-income home buyer. He's got 3 generations that are in that same home for the first time. And DeAndre is not a low-income. He's my favorite special purpose example, where he works at Microsoft. He does really well. He's done everything right in life, but he's the first generation in his family to own a home, and down payment assistance was very meaningful to him. So we don't want to leave folks like DeAndre out, who doesn't qualify as low income, but absolutely needs DPA. So those tell those stories. So here's where I'm going to sort of round out on challenges and solutions. This is, again, not an exhaustive list, but we just put our heads together to say, what could we focus you all on for this discussion that we don't hear very often, and that doesn't get spoken about as much, and that's actionable. And so I described a little bit earlier about the problem statements in down payment assistance that go into the underutilization. There is a huge need for standardization and consolidation in that space. And that will meet the operating needs of lenders. and also just workflow needs of home buyers, just making it practical in today's environment, and also technology driven. So that's something that you can do with it. What does that mean to standardize your program? Certainly we're happy to help you with that, but it means making sure that programs are consistent across multiple geographies and not wildly different. When we have wildly different programs, which kind of what the landscape looks like now, if you're a lender looking at that landscape, it's so many different guidelines to review. It's so many different loan documents to review. It's so many different counterparty organizations to review. So standardization will not meet the organizational issue, but it will on the document side, it will on the guideline side, to make those standardized guidelines, standardized amounts, standardized documents. That is something that multiple organizations can do. Consolidation would look like getting together, whether you had a group like us do that, or whether you created a collaborative within a state or within a county that consolidated the programs and became the counterparty or the party that the lenders engage with in order to issue the DPA. We're happy to do that as well, where HCA can both host funds and get them out in any geography in the country, and we can help you to standardize and match programs that the lenders will easily uptake and help you deploy. Because ultimately, we say access to credit is a loan officer, and a loan officer needs to be trained on your program, and they work for a lender. And so in order to solve for that, we have to make programs be palatable and workable with lenders. That's who's doing the volume of this. The second point here is the affordable purchase math just doesn't meet the market needs and home prices in so many places around the country. Not everywhere, but specific, a lot of high cost markets are they're spread around the country, and they're certainly on the two coasts. There are a lot of high cost markets, and it means, what do we mean by this affordable math? We mean that 80% AMI is even with significant subsidy isn't able to purchase a median priced home in many of those markets. And so one thing that we are sharing with folks out there is that we see this over and over again. We've heard it by many groups around the country, that we think of this generally in the affordable space as 80 to 120. So we're serving, most HUD approved organizations serve 80% AMI to 120% AMI on average, that band. But the truth is that most guidelines are restricted to 80% AMI, or anything that is restricted LMI either must be an LMI census tract or a low moderate income person, which it only goes up to 80% AMI, not the moderate level of 120 or 100. So our point that we're putting out there for all the advocacy groups is to think about this. What if we moved that mark to 120% AMI? And if you weren't comfortable with that in your market, maybe for high cost markets that we would do that. Essentially, if we could, from a policy perspective, get the LMI to include the moderate income, we would end up helping a lot more folks. There are people that are at 120 or 100% AMI all over the country that lack down payment, that lack access to home ownership, and that could be converted from renter into home ownership. I think Shariar's presentation was a great basis on why I personally work in home ownership, why it's so important, and the vast difference, the life-changing difference it makes. And so we've got a lot of folks who have the ability to repay, who are going to be strong home buyers if they could just get in. And they're at that 100 and 120% AMI. Also, if you care about communities of color in particular, first generation home buyers, communities of color that are doing well and can actually buy a home in their market are often in this band and are not low income. So we don't have the low income tools to help them, even though they need it from an affordability perspective and as a first generation home buyer. So that's why we advocate to move that mark and to get more moderate income folks included in low income programming. for home ownership in specific. Another tool that you could advocate for is longer term mortgages. If we could stretch the term, this is certainly something folks not everyone's comfortable with, but if you look at a place like Japan, they have 100-year mortgages and a very, very expensive, very small piece of land. And then finally, around closing the racial home ownership and wealth gaps that we see out there and that have persisted for so many decades, we really need to bring SPCPs back to the GSEs. So our president issued an executive order that ended DE&I. That DE&I order has been interpreted throughout the federal government, and when it came to Bill Pulte's desk, who oversees the FHFA and both GSEs, the way he interpreted it is that they needed to end anything race-based, which included majority minority census tract designated programs, and that included special purpose credit programs. And that basically put that to an end with the GSEs. Thank goodness our banks out there can still do this with their portfolio, but we really need that brought back to the GSEs. So hopefully sooner than later, when the winds change. And that, folks, is it. I'm looking forward to any questions and chatting with you. And I will turn it over to Sharon. Or Linda, you're going to take it again.
Yeah, let me turn it over to Sharon. What happened? Okay, Sharon, let me give you control.
Sure.
Yes, there you go, Sharon. You should have it. Yeah, there you go.
Okay, I see it.
Yeah.
Perfect. Too far. All right, thank you so much, Linda. Thank you so much for this invitation by Consumer Action, and thank you for being able to follow two great panelists. I really appreciate the sort of comprehensive view that we're kind of sketching in this webinar, going from renters to kind of credit challenges for homeowners, to kind of zooming in this presentation on housing challenges in rural areas. Especially so for home buyers and homeowners. So in this part of the webinar, I'll be talking, sharing some findings and implications based on a CFA report, the Consumer Federation of America report we published back in April. The full report is available online, and the research that I'm presenting here benefited from funding by the Pew Charitable Trusts. So, I think Shariar and Gabe set it up well. I think everyone is aware that we have a national housing crisis. This is not a partisan point of view. We were seeing this acknowledged by people across the political spectrum. Home buying has reached its highest point, highest cost in decades. The average age of first-time home buyers just keeps climbing up. But many of the stories that we read in the national news often focus on urban areas, especially large cities such as Boston or New York City, LA. We're hearing about high rents there, sort of issues around gentrification, and also NIMBY resistance to building more homes. But our housing crisis, as I said, is truly national, right? It's become so dire that it's definitely also come to a lot of rural communities across the country. Think about Eastern Kentucky, for example, or rural Arkansas. But, the real question is, well, okay, as the housing crisis has reached these areas, how does it look differently, right? Like, how does the housing crisis look different for home buyers in Eastern Kentucky than for home buyers in Boston, right? So that's really what I'm going to focus on here. So in this presentation, I'm going to answer three key questions. First, what does our housing crisis look like in rural America? And I'm zooming in on the case study of Eastern Kentucky as an example of kind of thinking through these issues. And second, how are recent policy changes and the sort of budget bills that are being passed, how are those starting to impact the rural housing crisis? And then third and finally, what policy solutions would actually help resolve our rural housing crisis and really start addressing some of the issues I'll be raising in this presentation today. So as I said, this presentation and the report I'm talking about really zoomed in on one place, one case study to truly understand how, you know, a local community and homeowners and home buyers in a local community are experiencing the housing crisis. So I visited Perry County in Kentucky, which is the county of the town of Hazard. It's about a 2-hour drive from Lexington, for 10 days in October 2024. And, you know, as part of that visit, I just spoke to as many people as I potentially, you know, could find and could talk to. And I conducted over 20 interviews with local stakeholders who included local housing experts, academics, local lenders, realtors. I talked to a construction company, nonprofits, and as well as renters and homeowners and home buyers in the community. So Perry County is located in eastern Kentucky, in the Appalachian Mountains, and historically this was a coal mining community. Kind of the black and white picture kind of shows what kind of company housing looked like back in the days. But still today, most of the homes there are located in river-carved valleys alongside streams. And there's still a lot of poverty. Poverty has only been on the rise in the recent decades, as many of the mining industry that initially kind of fueled, jobs there has left over time. But the picture on the left shows that there's still a lot of physical evidence of it in the landscape, right? These kind of strip mines, mountains. So today I'll just present 4 key findings based on that in-depth look at housing in this one community, and specifically kind of home ownership challenges. So first, one contradiction that I encountered immediately was that many houses are vacant. There's definitely a lot of vacancy there, but at the same time there's still a housing supply shortage. So how is that possible? Well, it's possible because too few homes are both affordable and adequate, right? There's a lack of homes that people could actually kind of live in, and that are affordable to fix up, basically. So when I spoke to local home buyers, several of them mentioned kind of the same dynamic. They struggled to find something that was neither over budget, so neither like $250,000 or up, or like was perhaps $30,000, but a total gut job, right? They said that there was very little in between these two extremes. So we can also call this the rural housing gap, kind of a gap of of homes kind of in the middle that are affordable, but also don't need very expensive repairs. So this sort of observation was also affirmed by kind of quantitative research. So the University of Kentucky found, for example, that in 2023, 1 in 8 homes in Kentucky could be deemed inadequate, for example, because they didn't have complete plumbing facilities, or not a functioning kitchen, or had flooding damage. So there's a lack of homes that are kind of adequate and affordable. The second key finding that I found, kind of looking at this rural housing market, was that many homes are family owned. Many homes are and lands are inherited through the family. As owners pass away, they often don't have a will, which means that homes then become the ownership becomes dispersed across all the heirs. So this is also called heirs property, where there's many owners basically of a property that sort of creates difficulty in kind of cleaning the title, being able to sell it, or even qualify for benefits sometimes. So there's two kind of big consequences of that. One, it makes it much more difficult for home buyers to buy homes, or even find homes that are available. One of the people I spoke to said, well, I found a home and land that I was really interested in, but then I realized that it was owned by like 20 different people. So she didn't want to go track down over 20 heirs, like, who may live all over the country. Another sort of another sort of impact of this is that a lot of homes become transacted in informal ways. So I encountered a lot of people, for example, who like kind of informally rented a house that was owned in the family. But many of these homes were in terrible quality, right? Because they were just sort of, they used to be the grandparents' house. Now it was inherited through the family and it was vacant. So it was kind of an affordable way to kind of live there. But, no one was really maintaining this housing stock, right? Because there wasn't a clear owner. A lot of homes were sold like even on Facebook or, Craigslist, some locals said that, they saw Zillow only as sort of a place, the MLS as sort of a place of last resort to sell a house. So that kind of complicates home buying. And that also can kind of deepen disrepair and vacancy of the housing stock when, they're tied up in title issues or they kind of become transacted in this very informal way. So the third kind of key thing to understand about, home buyer challenges in rural areas is that there's often a mismatch. Like there is housing finance, there are lenders, we have all kinds of mortgage products, but there's often a mismatch between the actual needs and the mortgage finance that's available. And I think, Gabe also kind of started talking about that a little bit. In this kind of poor rural community, there's first of all a mismatch due to financial situations, right? So there's a lot of lower income households. There's a lack of well-paying jobs, what locals also called kind of the big jobs. So the only big jobs in Hazard, in the town of Hazard, was that there was a local hospital, a rural hospital, and there were some coal mining jobs remaining. But there weren't many other kind of high-paying or more stable jobs. Even though this particular community wasn't like, we've heard a lot about kind of banking deserts and sort of the lack of access to banking services. But even though Hazard wasn't, a banking desert, at the same time, it was also a payday oasis. There were a lot of sort of, check cashing places, kind of payday storefronts, right? So this was reflected in a lot more debt that people held and lower credit scores. So, for example, if you look at the map, the right side, you see that in the Eastern Kentucky, has much lower credit scores on average than the rest of the state. So this makes it difficult to qualify for a mortgage. The second is, there was also a mismatch between housing finance and the quality of the housing stock. I spoke to a local lender and they did a lot of small dollar mortgages. Like they had no qualms about originating, a mortgage that may be only, $40,000, but they did not have a renovation product, right? So that $40,000 would only work for a house that's basically move-in ready, or where you have the cash to kind of do the remaining repairs, but that was not the nature of the housing stock there. So kind of difficulty to kind of actually get a mortgage for the types of houses that were for sale and that were potentially affordable. So the final finding that I will present here is the climate vulnerability of rural areas. So, I don't think this is a surprise, but there's an increasing vulnerability to climate disasters really across the nation. There's not many climate like heavens, like that are left, and this includes a lot of rural communities as well. Rural communities are also uniquely vulnerable because of their older housing stock, and rural communities often have more limited local resources to respond if a disaster strikes, and limited resources to rebuild. So the area of Perry County saw a devastating flood in 2022. Many people lost their lives and more than 9,000 homes were destroyed in this area due to the flooding. Again, as I mentioned before, a lot of homes in this area are located in river valleys, basically. So they, are very vulnerable to kind of flash floods in the mountains. Actually, flooding happened again after I visited in February 2025. Big chunks of the town of Hazard flooded again. So this creates unique challenges for homeowners and home buyers. So when I spoke to a local lender, he actually told me to come back the next day because he was very busy that day. because he was busy kind of sending out letters to homeowners that had a loan with them to inform them that now all of a sudden they were located in a FEMA flood zone, so were required to start carrying flood insurance for the first time. So, there is this sort of double vulnerability that comes from this, right? So the sort of financial struggle of being able to afford homeowners insurance, where costs are going up, or the combined burden of homeowners insurance and flood insurance on top of your mortgage. These cost burdens can be particularly high for, rural communities where incomes are generally lower. But then also, of course, the struggle to rebuild and to have a chance at sustainable homeownership in the face of natural disasters. So that brings me to federal policy changes that have been happening over the last few months, and the sort of new challenges that this really presents, thinking about housing challenges in rural communities. So first of all, the THUD spending bill, I actually changed my slides, just this week, because the House, just introduced the new version of this spending bill. In the initial spending bill proposed by Trump, 44% of cuts were proposed for HUD overall, all the housing programs by HUD. But advocacy helped. A lot of people spoke up, showed the sort of detrimental impact this would have on people's ability to stay in a house, rental housing, public housing, all the types of community development programs and sort of investments that HUD does. So I was really, it's not a perfect bill by far, but it's definitely preferable over the initial steep cuts proposed by Trump. However, in the new THUD bill that was introduced, we still see a $1 billion decrease in budget for HUD from 2025 to 2026. So this includes steep cuts to housing counseling, steep cuts to the or elimination of the home investment program, which has helped for community development investments, steep cuts to fair housing programs across the board, as well as steep cuts to the public housing capital funds, which helps maintain our nation's public housing stock. So it's important to acknowledge that in the middle of this housing crisis, we're still seeing a reduction of budget go at the federal level going to houses rather than an increase of that. Two, big threats to FEMA and the NOAA. We're seeing already a lot of staffing shortages happening at FEMA, which has really hamstringed this agency's capacity to respond to disasters. Over the summer, we've seen a lot of different disasters happening across the country. There was a tornado in St. Louis. We just saw devastating flooding in Texas. And we're seeing that the FEMA is kind of slower to respond and has challenges in responding to these disasters. So there's been calls by the administration to even eliminate FEMA, but especially for rural communities, things like FEMA have offered a lifeline to be able to rebuild and to rebuild in a more resilient ways, rather than being basically cut off from everything. So this is really important. Like, if anything, we need more investments in FEMA rather than less to ensure that as a nation we can be more ready for disasters and we can be more resilient moving forward. And then third, I just want to flag the sort of impacts of the so-called Big Beautiful Bill that was signed into law on July 4th. So this bill, in this bill, there's deep cuts to Medicaid and SNAP in particular over the next decade. And it's really important to realize that 1 in 4 adults in rural areas receive Medicaid, and that Medicaid has been a lifeline for rural hospitals and rural medical facilities in particular. So it's estimated that net, these cuts would result in a $100 billion loss over the next 10 years just in rural areas alone due to these cuts. So there's a lot of housing consequences from this as well. Think about, the loss of local jobs, rural hospitals closing, or the loss of supported housing that's funded through this, that really can, further undermine communities and increase poverty in these places. So moving away from that, it's clear that we don't need that cutting funding to HUD, cutting funding to FEMA, and undermining Medicaid are not helping housing in rural communities. So what federal policies would actually help rural homeownership? I think there's many ideas out there, but I just want to flag 3 big ones here. Is, of course, to protect and fund these essential programs that we already have, and to really direct resources into rural communities to allow them to build more homes, to invest in resiliency, and help communities rebuild safely if struck by disaster. Second, there's a lot of needs to expand mortgage finance options that better fit rural needs. There are already the USDA direct loans are a great resource for a lot of rural communities. For lower income home buyers, they offer a product that has a 0% down payment requirement and kind of a longer loan duration to lower monthly costs and make homeownership more within reach for a lot of home buyers. But we also need to think creatively about other potential mortgages beyond the USDA program. So these include FHA 203K renovation loans, which are ways to both finance the purchase of a house and to finance the renovation, which, as I indicated earlier, there's a lot of disrepaired vacant housing, especially in rural communities, that could really benefit from this type of mortgage product. It exists, but there's a lot of limitations to this program right now that make it difficult to use, and it's much underused. So a lot of potential there to improve that and cut some of the red tape and make it more usable. And then, Fannie Mae and Freddie Mac, it's really important to keep them on track to think about innovative mortgage products, such as through their duty to serve mandate. Thinking about manufactured housing loans, for example, to really meet those affordability needs in rural communities. And then finally, thinking about, I think the theme of home repair really ran through this presentation, but thinking about really finding ways to invest in our nation's existing affordable housing stock more. The way out of this supply crisis is not just by building more, but also by ensuring that the homes that we have, are livable and, resilient. So, one promising bill that was not passed this year was the Bipartisan Neighborhood Homes Investment Act, which is a a tax credit meant to spur investments into our nation's disrepaired housing stock and to make them ready for home buyers, basically. So the tax credit is conditional on selling to a home buyer, to an LMI home buyer. So this is federal level, but there's a lot also that can happen at the state level. So what can states do to support rural home ownership? 3 ideas here. One, as the federal government retreats from investing a lot in housing, it's really important that states step up in investing. One way, oh, I think I went too far. There you go. So one way to do that is to ask them to set up housing trust funds and levy taxes specifically to fund housing trust funds that they can use to invest in housing construction in the state. Another one is to really support the work that state housing finance agencies are doing. They are able to issue tax-exempt housing bonds that allow them to invest in multifamily construction in the state, or to offer unique mortgage products that are subsidized through these housing bonds that can offer lower mortgage rates, or DPA programs as well. So there's a lot of capacity here to kind of do more and to work with them. And thirdly, work with regional federal home loan banks in your region. There's 11, so they're kind of, all over the country. But their mandate really is to, help invest in housing. So work with them to kind of make sure that they meet the needs of your, communities. And one way to do that is for them to step up their investments in rural housing. For example, many of them have mortgage purchase programs, which offer an alternative secondary market, especially for small lenders who may not have access to Fannie Mae and Freddie Mac. So this can help support more rural mortgages and more kind of unique mortgage products as well. And second, they are required by Congress to offer affordable housing program contributions every year, but they're also doing voluntary housing contributions. So kind of, I would, encourage local community organizations and advocates to kind of ask them about that, and give them suggestions about where to really spend those dollars, where they can make the biggest impact. So finally, just ending on a positive note, what can you do? I think there's a lot of potential in the next few years to do a lot of great work at the state level, and people that are located locally are best positioned to do that kind of advocacy, kind of really knowing and understanding local needs. So really make sure that you have these conversations at the state level to address our housing crisis. Second, it's always important to educate people around you on, what is exactly happening at the federal level, how that's really impacting housing. There's always room for, op-eds in local newspapers to kind of defend FEMA or defend the home program, for example, that's still under attack right now. As I noted, it seems that previous outrage over the initial proposed HUD budget cuts really paid off. So I would encourage everyone to keep up, a loud voice on these issues and really show why it matters for your community. And then finally, keep building strong local partnerships. The housing problem is not going to go away on its own. It cannot be solved by any one, solution. It's not just about helping renters or helping people with down payment assistance. It really demands comprehensive action. So the more you can build kind of local partnerships, the more powerful of a coalition you can have locally to really make a change. So definitely encourage people to keep doing that. And that was it for me. Thank you so much. And I'm sure our slides will be shared afterwards, so you can find more resources here as well.
Great, Sharon, thank you. A special thanks to Sharia, Gabe, and Sharon for some awesome presentations. Okay, audience, now it's time to hear from you. We want to hear your questions. So let me turn it over to Nelson so he can present your questions to our speakers. Go ahead, Nelson.
Hi there, Linda. Can you hear me okay?
Can hear you just fine, Nelson.
Okay, great. Thanks. We do have a lot of thoughtful questions here for all the speakers. And speakers, of course, you can, if you answer one question and another speaker wants to add to it, that's perfectly fine. The more we can learn today, the better. We did have one question addressing a point that was made by Sharia earlier, that renters were able to build wealth. You listed several things like retirement accounts, investing in stocks, etc. One of the bullet points was about investing in real estate somehow. Can you tell us more about that? And also, is that something that can be done more of somehow? Is that if somebody's not going to go the homeownership route right away, how can they invest more in real estate and reap benefits?
Yeah, thanks for that question. What we weren't able to see was like a closer examination in terms of when we looked at that gain in real estate investing, like what exactly those kinds of investments were. We saw that category increase more broadly, I think one thing we could be seeing is this could be renters who might have higher incomes and they had more ability to invest in real estate, although their primary residence was still a renting situation. It could have possibly been coming from the lower income side though, but that's not something I can confirm right now. In terms of expanding though opportunities to invest in real estate more broadly, I think there are innovative models when it comes to shared ownership. Particularly something that our program has talked about is inclusively owned commercial real estate, where a commercial property is opened up to local community residents to be able to purchase a share and be able to have an appreciating asset that appreciates with that commercial property. And then they could use that then they could use those savings to fund a variety of other purchases. So that's one potential solution there that we offer when it comes to real estate.
Great, thank you, Sherry. Any thoughts on that, Gabe or Sharon?
There's a lot of different ways that borrowers can go in together and utilize a mortgage. I mean, a mortgage allows standard URLA, the Uniform Residential Loan Application, allows up to 8 borrowers. So you can get really creative in co-purchasing a property with a standard mortgage, and you can put together an LLC and have the LLC get a commercial loan for real estate that a group owns. So just, you know, and that exists at all kinds of scales. And there are absolutely examples like Sherry just referenced. I have a friend in Seattle that does this, that is an affordable developer and does commercial properties, and they sell down to $100 shares to community members. So, you know, they're buying $100 share in that commercial property that will appreciate over time.
Excellent, thanks. Good thing you gave us, everyone's providing their contact info in case we, you know, need to hear some more examples or others want to reach out to you about that. You talked about, of course, a lot about special purpose credit programs, Gabe. Are they long-term? Are they safe? Or I know you said things were not as bad as they could have been, but is there a long-term safety for the program, or are any threats looming?
I think it's a provision of the Equal Credit Opportunity Act. So in order to change that, you would have to amend the Equal Credit Opportunity Act, which would take a long time, to say the least. So, you know, what I have heard from my policy wonk friends and legal friends, as well as everything I've read and observed, is that we're on safe ground from a law perspective, legal perspective. In other words, it's the Equal Credit Opportunity Act, and it's the fair housing laws that often, and fair lending laws that are driving a lender's behavior to make sure that they don't have disparate treatment and disparate impact. I mean, they are literally measured against that, and they could have regulatory findings. So they have regulatory risk if they do it in a way that yields disparate impact. And there's a variety of ways that that's monitored through a range of regulators, actually, or just the investor themselves. Like FHA has a system called Neighborhood Watch. So HUD is looking at all the FHA lenders to make sure that there's not disparate treatment. And so anyway, that is a long way to say, I think we're okay from a legal perspective, and long term, I don't believe that will change. The other wins that matter, other than just the policy side, is the business aspect of it. And so you've probably read some of Urban's reports that talk about the home buying future, what that population looks like. And 7 out of 10, if I'm getting that right, I think it's 7 out of 10 household formations will be within a BIPOC household. And household formation is one of the largest drivers to home purchase. And so home purchase, that whole market, will be driven by communities of color. And And SPCPs, as lenders did issue them and are still issuing them if they've got a way to do it without the GSEs, are performing well. So we're happy to say that and happy to see that they perform on par or better is what we're hearing than any other low down payment program. And so from a credit risk perspective, they're performing well. From a business market share perspective, their expansion of business and additional production. And so those business wins are good, and that will continue. And so what we've heard is that, for instance, I mean, to paraphrase a lender, well, that may be what's happening politically, but we're not changing our business strategy. Or we've relabeled some things because of the political winds, but we're still not changing our business strategy. So the strategy is still there within lenders to go after these gaps and to close them, because those gaps equal opportunity if you're a lender.
Excellent, thanks. I didn't know we were going to hear so much good news today. So thank you for that. Our next question, a really thoughtful question. It's a little bit long, but it has a few different things to think about here. Someone shared, they said, we walked away from our home in 2010. They needed to move. The house was underwater, owed over $300,000, and the value of the house had dropped $175,000. Then they say, we never purchased again and instead invested in a retirement fund, now converted to an IRA, and they sleep better at night, especially now that a new housing crash, they say, is looming and many recent buyers will lose their investment. So in terms of investment, which is safer and provides a higher yield, housing or a safe retirement investing? I'm trying to educate my Gen Z daughter.
Well,
Lots
I
of
mean,
things for everybody there.
this, but I would say that the data shows you that wealth is not from stock ownership. Wealth comes from owning a home and owning a business, by and large, in America. And so, and not by owning a share of a business or some shares of a business. So when you look at the source of wealth and the largest sources, it is not stock ownership. And stocks, you know, I see you've said some sort of low risk, which is great, because there is a lot of inherent risk there. The other thing about home values is that one shouldn't be buying a home for a quick turnaround. That's investing. That's not just buying your home and having the home stability, paying the mortgage down over time, and building equity that way. So that even if your home never went up in value, if you just paid the mortgage over time and paid it off, you would have the value of that home, and that you would have built that equity. So I think we've all been trained that the increase in value is where you get equity, but the traditional way of building equity is to pay off your mortgage and own it outright at the end. And so, and then you could, if you had no other retirement plan and you owned your home, even if you didn't own it outright, you could get a reverse mortgage that would then be retirement income for you and allow you to stay in the home. So I'm always going to lean on home ownership. The other thing, I'll say one last thing about it, and then someone else should say something positive about stock ownership, Sherry R maybe, is that when you go to buy stocks, you cannot buy $100,000 in stocks for $3,000 down. But you can buy a $100,000 home for $300,000 or for $3,000 down. And when you appreciate on that asset, you will appreciate on $100,000 if it's a home, a percentage of that. And if it's a stock, you will appreciate on just the 3,000 that you bought. So it is a smaller nut with smaller percentage, or even if it has equal percentage, has smaller increases. And I think Sherry R's data showed exactly that.
Can I chime in on this? I think it's a really important question, and I think that it is fair to acknowledge that the dream of homeownership doesn't always deliver, right? And that, I think, especially if we're talking about Gen Z, people are thinking about alternative models, to build wealth too. Like in the United States, we've so heavily hedged on home ownership as sort of the one way to kind of reach the middle class. That's why there's so much government programs and homeownership is much more subsidized than renters in this country. But it doesn't mean that the dream of homeownership, always delivers. So I agree with Gabe. Like, research, research that I've seen says that it's, it takes homeowners on average 7 years living in their home to start really building wealth to, for homeownership to start paying off. But, I think there's nothing, nothing certain in this world, right? So I think the best strategy is to see where you can diversify your portfolio where you can, and that could be a combination of, holding stocks, some savings, owning a home, but then also realizing that a home offers more value than just sort of a financial investment. I think we should move away from this idea that, I think we've moved too far into the financialization of housing. Even for those who, I lived in Detroit for a while, even for, I met many people for whom the dream of homeownership, did never kind of had a payday, but they still enjoyed the stability of it, right? And they still derived a lot of pride, and they had a place to safely, raise their kids. They could, they're kind of retiring in their home. They had a place to live, right? So there's more value to homeownership than just the financial picture of it. But I think we can be honest that, it doesn't always deliver.
Yes, 100%. Thank you, Sharon. I have my bias, I admit it.
Okay. I'll move on to the next question. I guess, there was this thing about the looming housing crash, but I mean, it sounds like you have to write it out if possible, right?
Yeah, I mean, we're not facing another 2008. 2008 was fueled by a great deal of people who should have never owned homes. We do not have those kinds of mortgages being written today. People who are getting a mortgage actually can repay that mortgage. They have the ability to repay. I'm very, very thankful for the regulations, the Dodd-Frank Act that came out after 2008. We see safe and sound lending. There is no nonsense lending happening now. Now, that doesn't mean that there are not other macroeconomic factors that can happen. And certainly in local markets, you can see swings in prices, and people need to know their market for sure. But I think, as Sharon agreed with me, this should not be a short-term scenario. Homeownership is a very long-term, very stable, in the same place for many years approach to maintaining affordability, avoiding increasing rents, and building wealth.
Great, thank you. And if I could, we do have another good question here. I just want to get this in. If you had any examples or anything to discuss about renters' equity laws and programs. So the person asking here says that they're aware of a trial program that happened in Ohio where renters were earning money for the number of years that they were essentially good tenants, doing regular maintenance, etc. And then they'd receive $2,000 or $3,000 afterwards.
Sure.
And then, but apparently what happened in the program they're remembering, it was not as successful or not successful because somehow the investor money did not work out financially, I guess, for the investors. So is there a way maybe that what the money that should be going in there is actually the renter's money or the landlord's money? Is there another way to do them, or what do you know about these programs?
I mean, I think what you're referring to, I guess I'll speak as a cooperative model. So there are cooperative affordable rental properties. My old organization used to be a general partner in several. And in those cases, the tenants actually do own a portion of the entire property. And there was some wealth building for those renters. So that is a model that exists out there.
Yeah.
What else can you add to that? Please jump in.
No, that, there's definitely, we see more spaces emerging between the dichotomy of renter versus homeowner, right? So I think this is an example of that. Another example is sort of shared equity programs where, the homeowner shares the gain of, gained equity over time with, a nonprofit, for example, or, there's sort of long-term affordability restrictions placed on the home to restrict, the equity gains that a homeowner can gain over time through homeownership. So this is another way to potentially subsidize homeownership and to give people a chance at homeownership while, also protecting affordability over time. So yes, I think there's some that if to the extent that this potentially, offers renters a chance at, wealth building in, renters that would not have been able to get home ownership otherwise, I think these are great models.
Excellent. And then we're just going over time. I just thought, Sharon, you kind of told us at the end what you thought the attendees today. We have a couple hundred organizations that serve clients every day. These are frontline community organizations. What should they be telling their clients after today, after coming to this workshop? What's the key message from your presentation to the client?
I mean, I imagine Gabe and Sherry may have a takeaway message too, but I think our message is hopeful, right? That there's still a lot of great ideas out there. There's a lot of energy at the state level, even if we're kind of fighting hard battles at the federal level. That there's definitely, we're in this unique moment that there is this. I don't think we've ever been in this moment before where there's such a wide recognition of like housing as a national issue. So, really leveraging that awareness in this moment and mobilizing, homeowners, home buyers in your area to make a positive change. I think that's my takeaway. Yeah.
And Gabe or Sherry, are any final thoughts?
When you're buying a home, if they're considering a home purchase or in a home purchase process, it is literally the biggest transaction of our lives. And it's also one of the most difficult things, especially on your first purchase, that you'll ever make happen. So it requires a lot of diligence, a lot of patience. Sometimes you don't, or you're not successful. So a purchase can fall out, or a loan product can fall through in some way. And so it takes really not giving up and staying at the plate. I have seen too many times people weren't successful in their first attempt, and they wanted to feel good about themselves, sort of in that middle class space that they really truly are if they were considering buying a home, right? Or if they were in that process, and they go out and buy an expensive car. Or maybe they go and rent an even more expensive place so that they can sort of upgrade in that way. And then that prevents them from really achieving their goal and from advancing their goal. So don't let people give up. That's always give them hope and show them some pathways, give them resources. And at the end of the day, you got to stick with it.
Thank you, Gabe. Sherry, anything else?
I can offer some brief final comments. Just that I think it's important to acknowledge just the discrepancies between renters and homeowners, not just in the difference in their housing status, but how that relates to their financial situation overall. And just acknowledging that financial hill to climb is so much bigger for a lot of renters than homeowners. And that when we're serving them, we just have to acknowledge those unique kind of challenges and be really open to across the board solutions, both to help them become homeowners, but then also address challenges even when homeownership is out of reach, so that they still have that opportunity to build wealth regardless of where they are in their journey.
Excellent. Thank you so much, Gabe, Sharon, and Sherry. I'll back to you, Linda. Thank you.
Thank you, Nelson. I want to join Nelson in thanking our guest speakers for their presentation. It was totally awesome. If you enjoyed the webinar and wish to support consumer action, there are several ways that you can do so. You can donations can be made online via credit card or PayPal, or you can click on that little link below, or by visiting our website at www.consumer-action.org/giving, or you can mail us a check. We like checks. You can mail a check to Consumer Action, Attention membership given, 57 Post Street, Suite 704, San Francisco, 94104. Another way that you can support us, another impactful way to support us is by subscribing to our YouTube channel. Subscribing is entirely free and it comes with several benefits. One, you will receive notification whenever we upload a new video. And number two, your subscription helps signal to YouTube that our content is valuable, enhancing our visibility to a broader audience, okay? Once again, a huge thank to our guest speakers for their outstanding presentation. You totally rock. And a special thanks to all of you for taking time out of your busy schedule to join us today. Uh, it is your support and your participation that make our event successful. And so before you sign off today, please complete that evaluation. Your feedback is not only welcome, it is valuable, it is crucial in helping us improve and provide you with the best possible experience. Wishing you an excellent rest of your day. Goodbye and take care until next time.